Welcome back. Cruise line operator Carnival raised its annual profit forecast earlier today, but the company also says it will be affected by the Baltimore bridge collapse. For more on this, let's bring in an expert on this stock. He's Jaime Katz, senior equity analyst at Morningstar. Jaime, thanks a lot for joining us. I'm seeing on my terminal that Carnival raised its outlook for 2024 amid record-setting demand for cruises. However, the company also cited a negative impact related to that big event of yesterday, that collapse of the bridge in Baltimore. Tell us more about what Carnival is saying.
Yeah, I think most of the commentary coming out of the quarter was really pretty positive. It looks like consumers are very interested in consuming the product. There were something in the order of nearly $7 billion in bookings or advanced ticket sales on their balance sheet. And you know, all of that is coming in at a higher price and on a booking curve that's a little bit better than it has been in the past. So people are willing to book out earlier than usual. As for Baltimore, you know, I think it looks like that's going to be a fairly negligible impact. I think they said something in the order of $10 million, and obviously very tragic, but they were already able to find an alternate port to use, so should not be materially impactful over any sort of extended period of time.
Is the boom in cruise bookings for real? Do you see this as sustainable?
Well, I think we're, you know, seeing that it's going to travel down to a more normalized level. So are more people booking earlier to get the rooms that they want and the pricing that they want? Perhaps. But we are seeing pricing set to normalize over this year, right? So at the beginning of the year, in the first half, we're going to have double-digit yield growth year over year at Carnival, it's looking like. And then in the back half, that goes down to a mid-single-digit price increase. And in our longer-term outlook, you know, we have that closer to historical levels. So low single-digit, you know, maybe 3% growth over time.
I understand that going back to geography and events, we've already spoken about Baltimore. The company also has some level of exposure to the Red Sea, which of course has been a hot spot because Houthi rebels have attacked vessels in that area. What has the company said about the Red Sea?
I think for most of the industry, we've heard that there were going to be ship redeployments from the region, and that had happened earlier in the year. And so it generally has not been a significant percentage of deployment, and they've been able to find new homes and new itineraries for ships that were traveling through the region.
What is your outlook for earnings this year, earnings growth?
I mean, going into earnings, we were around 93 cents a share for EPS, for around 90 cents a share for EPS. They came in at around 93 today with their updated guidance. So we don't expect to make any significant or material change to that. And I think, you know, that is in line with largely the street. The street was around $1 a share prior to the results today.
How competitive is this sector right now, and who are the competitors? Obviously, other cruise lines are competitors, but I assume land-based options for travelers are competitors as well in a very real sense.
For sure. And land-based is a key competitor. But I think what the cruise operators have talked about at length is that the value proposition is still significantly better for the products that they're selling, given that they're including things like meals, entertainment, activities, and you can also add on excursions on top of that. So when you think about it on a per diem spending basis, it's a lot more efficient for a family of four, price-wise, to take a cruise oftentimes than it is to take a land-based vacation, depending on the destination.
You've got a buy rating on this stock and a price target of $27.50 US per share. How do you arrive at that price target?
So our price target is an intrinsic value. It's based on a discounted cash flow model. Over time, we have price growth and probably around 3%, cost growth around 2%, and then modest capacity growth over time in line with the shipbuild order book that Carnival has alluded to. And that is how we get to our valuation.